Here's something that might genuinely unsettle you. For more than 140 years, the United States of America had no financial regulator, no Securities and Exchange Commission, no federal cop on Wall Street, no agency you could call, no hotline you could dial, no watchdog with the power to walk onto a trading floor and demand to see the books. And yet, somehow, railroads were financed, fortunes were built, entire industries were conjured out of nothing, and the largest stock market on Earth was constructed on top of a system that answered to no one but itself. So the question isn't just some dusty footnote for economics professors, it's actually kind of chilling. Who was watching the most powerful market in the world during all those years when, on paper, nobody was watching at all? And perhaps more importantly, what happened in 1934 that finally put a sheriff on Wall Street, and in doing so, permanently changed the relationship between the ordinary American and the money that runs their life? The answers take us deep into a forgotten world. A story about a handshake under a buttonwood tree and a swindle in a back alley betting parlor. About con men selling shares in oil wells that didn't exist, and titans of finance being dragged, one by one, before a snarling little immigrant lawyer in a Senate hearing room. About the single most spectacular financial collapse in human history, and the strange, almost unbelievable irony of who ended up in handcuffs when the dust finally settled. Because here's the thing most people don't realize. For most of American history, the stock market wasn't policed by the government at all. It policed itself. The referees and the players were the exact same people, wearing the exact same expensive suits, belonging to the exact same private clubs. And the story of how that cozy arrangement finally shattered, of how a nation that worshipped the free market came to demand a cop on Wall Street, is one of the most revealing chapters in American history. A chapter that explains, in many ways, why the financial system you live inside today looks nothing like the one your great-grandparents were quietly robbed by. So let me take you back to the beginning. To a spring morning in 1792, on a dirt street in Lower Manhattan, where 24 men made a private deal that would define American finance for the next century and a half. The date was May 17, 1792. The place was 68 Wall Street, in the shadow of a large buttonwood tree, a kind of sycamore that once shaded the sidewalk. And there, 24 of New York's leading stockbrokers and merchants signed a short, almost absurdly simple document. It came to be known as the Buttonwood Agreement, and it contained just two real promises. First, the signers would trade securities only with each other, and second, they would charge their customers a fixed commission, a set rate that none of them would undercut. That's it. That was the founding charter of what would eventually become the New York Stock Exchange, the beating heart of global capitalism. And notice what it actually was. It was not a public institution. It was not chartered by Congress. It was not answerable to any voter or any court or any regulator. It was a private club formed by a handful of insiders whose founding purpose was, quite literally, to keep outsiders out and to guarantee that everyone inside got paid. Now, this might sound like a minor historical curiosity, but it was actually the seed of everything that followed. From the very first day, the American stock market was built on a principle that would prove both brilliant and catastrophic. That principle was self-regulation. The idea was elegant on its surface. Who better to police the honesty of stockbrokers than other stockbrokers? Who better to write the rules of the game than the professionals who played it every day? The exchange would set its own standards, admit its own members, discipline its own bad actors, and keep the government at arm's length. It was a gentleman's club, and it ran on a gentleman's code. And for a while, in a small, tight-knit world where every broker knew every other broker by name, and a man's reputation was his most valuable asset, that code sort of worked. If you cheated, you were expelled. If you were expelled, you were ruined. Reputation was the enforcement mechanism. But here's the critical detail that most people overlook. A system that runs on reputation only works when everyone in it has a reputation to protect. It works in a village. It falls apart in a nation of 100 million strangers. And as the United States exploded across the 19th century, as it built railroads and steel mills and telegraph lines, as it transformed from a coastal republic into a continental industrial colossus, the number of people who wanted to buy a piece of that growth exploded right along with it. Ordinary Americans, farmers, shopkeepers, widows, schoolteachers, clerks, suddenly had a little money to invest and a burning desire to get rich. And into that gap, into the vast and growing distance between the small clubby world of Wall Street and the millions of hopeful strangers who wanted in, poured some of the most creative criminals in American history. To understand just how lawless this world was, you have to understand what a stock actually was to most people in 1890 or 1900. It was a promise on a piece of paper, and there was almost nothing stopping anyone from printing a beautiful, official-looking piece of paper, decorating it with eagles and engravings, and selling it to a farmer in Nebraska as a share in a gold mine, an oil field, or a rubber plantation that existed only in the promoter's imagination. There was no requirement to tell the truth about what you were selling. There was no requirement to disclose the company's finances, because in most cases there were no finances, and there was no company. The legal doctrine of the age was three cold Latin-flavored words. Caveat emptor, let the buyer beware. If you were foolish enough to hand your life savings to a smooth-talking stranger in exchange for a fancy certificate, well, that was your problem. The law shrugged. And so the swindles came in a flood. Promoters roamed the country selling stock in every imaginable venture, from silver mines in Mexico to plantations in the tropics, and in a staggering number of cases, the underlying asset was, in the blunt words of one contemporary official, absolutely worthless. Fortunes evaporated. Life savings vanished. And there was, quite literally, no federal authority anyone could turn to. But the most notorious institution of this lawless era, the one that best captures just how strange and predatory this world could be, wasn't the fake mining company. It was something called the bucket shop. Now, the bucket shop is one of those forgotten pieces of history that sounds almost too outrageous to be real. Picture a small storefront operation, the kind you might find on a busy street in Chicago or New York or Kansas City around 1900. It looks like a brokerage. There's a chalkboard, a ticker tape machine clattering away in the corner, men in shirt sleeves calling out prices. An ordinary person walks in, wanting to bet that the price of a certain stock will go up. He puts down his money. He gets a receipt. And here is the trick, the beautiful, evil trick at the heart of the whole operation. No stock was ever actually bought. Nothing was ever traded. The bucket shop simply took the other side of the bet. You were wagering that the stock would rise. The house was wagering that it would fall, and the house had a way of making sure it did. Because a big bucket shop, watching the real ticker tape and knowing exactly where a customer's money would run out, could quietly place a real trade on the actual exchange, nudge the price down just far enough to wipe out that customer's bet, and pocket the entire wager. The odds weren't just against you. The dealer could see your cards and was allowed to change them. And the origin of the name tells you everything about how the establishment viewed these places. The term bucket shop came from London in the 1820s, where street children would drain the dregs from discarded beer kegs, carry them in buckets to some abandoned storefront, and drink the leftovers. It was a word for scraping up the leavings, the garbage that respectable people threw away. That's what the financial world thought of these operations, and they weren't entirely wrong. But here's what should stop you cold. For decades, there was no federal law against any of it. The bucket shops were eventually shut down, but it took a patchwork of individual state laws, passed one by one, city by city, over the course of years, to finally strangle them. There was no national referee. There was no one watching the whole board. And that fragmentation, that reliance on a scattered, inconsistent quilt of state rules, would prove to be the fatal weakness of the entire pre-modern system. Which brings us to a banking commissioner in Kansas who, in 1911, decided he had finally seen enough. His name was Joseph Norman Dolly, and he was, in his way, the first real lawman to draw a line in the American financial dust. Dolly watched year after year as the good people of Kansas, farmers, small-town families, people with little business experience and a lot of hard-earned savings were fleeced by out-of-state promoters peddling shares in ventures that were pure fantasy. He is said to have complained that his state was being flooded with hucksters selling stock in every imaginable line of business, and that in most cases the stock was absolutely worthless paper. So in March of 1911, Dolly championed a radical new law, the first of its kind in the United States. It required anyone selling securities in Kansas to register the offering first, to open their books, to prove the thing they were selling was actually real before they could sell it. And the law got a nickname that was so perfect, so vivid, that it stuck for more than a century. They called them blue sky laws. The name came from the observation that some of these swindlers were selling ventures backed by nothing more substantial than, as one judge memorably put it, so many feet of blue sky. You were buying air. You were buying the wide-open Kansas heavens and a promoter's smile. The blue sky law was designed to make sure that when you bought a piece of the American dream, there was at least something solid underneath it. And here is where you can feel the momentum of history starting to build, because Dolly's idea caught fire. It spread like a prairie fire from state to state. Within just 20 years, between 1911 and the early 1930s, 47 of the 48 states had adopted their own blue sky laws. Only Nevada held out. It was a genuine grassroots revolt, ordinary Americans demanding, state by state, some minimum protection from the con men. But, and this is the tragic heart of the whole story, it wasn't enough. It could never be enough, because the blue sky laws had two crippling weaknesses. First, they were wildly inconsistent, poorly worded, and in many states barely enforced at all. And second, and this was the killer, a swindler could simply cross a state line. A scheme that was illegal in Kansas was perfectly legal one state over. Stock could be sold across borders, through the mail, over the telephone, in a national market that no single state could possibly police. The criminals operated nationally. The law operated locally. It was like trying to stop a flood with 48 separate buckets, each one a different size, most of them full of holes. So let's take stock of where America stood as it roared into the 1920s. The stock market, that private club born under a buttonwood tree, still policed itself according to its own gentleman's code. The bucket shops had mostly been swept away, but only by a scattered patchwork of state action. The blue sky laws stood guard at the borders of 47 states, but couldn't stop a determined crook from stepping around them, and over the entire national market, the market where the real money moved, where the great corporations raised their capital and the great fortunes were made and lost, there was still no federal watchman at all. Not one. The most powerful financial engine in the history of the world was running at full throttle, and nobody, absolutely nobody, was watching the whole machine. And into that unwatched, unregulated, gloriously overheating market came the most dangerous thing of all: optimism. The 1920s were a fever dream. The Great War was over, the economy was booming, and for the first time in American history, ordinary people, not just the wealthy, began pouring into the stock market in enormous numbers. And they weren't just buying stocks. They were buying stocks on margin, which is a polite way of saying they were buying with borrowed money. Here's how the fever worked. You could put down as little as 10% of a stock's price and borrow the other 90% from your broker. If the stock went up, your gains were magnified tenfold, and you felt like a genius. But if the stock went down, your losses were magnified exactly the same way, and your broker could demand the rest of his money instantly in what was called a margin call. Millions of Americans, school teachers and barbers and factory workers who had never owned a share in their lives were now leveraged to the hilt, riding a rising market with borrowed money, absolutely convinced that stocks only ever went up. And the insiders, the men who ran the club, knew exactly how to feed that frenzy. This was the golden age of the stock pool, one of the most brazen manipulation schemes ever devised, and it was completely legal. Here's how a pool worked. A group of wealthy insiders would quietly agree to target a particular stock. They'd start buying it and selling it back and forth among themselves, creating a flurry of activity on the ticker tape. To the outside world, watching that stock suddenly come alive, it looked like something big was happening. The volume was climbing. The price was ticking up. One insider later described the strategy in chillingly simple terms. You get the public excited. You advertise the stock through its own rising price. Ordinary investors, terrified of missing out, would rush in and buy, and their buying would push the price even higher, which would attract even more buyers, in a self-feeding spiral. And then, at the peak, when the public was all in and euphoric, the insiders would quietly pull the plug. They'd dump their shares at the top, the price would collapse, and the public, as one account put it with brutal clarity, the lambs, would be fleeced. The insiders walked away rich. The school teacher who bought at the top was wiped out, and none of it, not a single step of it, was against any federal law. Now, I want you to remember one man in particular, because his story is going to matter enormously before we're done. His name was Richard Whitney, and in the 1920s he was Wall Street royalty in the truest sense. Whitney had it all. Boston-born, Groton educated, Harvard polished, a member of the exclusive J.P. Morgan circle, a man who wore a small golden pig, the symbol of his Harvard dining club, dangling from his watch chain, like a talisman of belonging. He was tall, patrician, impeccably connected, and utterly convinced of his own rectitude. He would soon become the president of the New York Stock Exchange itself, the very embodiment of Wall Street integrity, the white knight who would defend the gentleman's code against all comers. Hold on to him, because the distance a man can fall is measured by how high he stood, and Richard Whitney stood at the very top of the world. For a few glorious years, the party seemed like it would never end. Stock prices tripled over the course of the decade. Everyone was getting rich, or at least everyone felt like they were. The market had become a national religion, and men like Whitney were its high priests. But a market inflated by borrowed money and insider manipulation is not a solid structure. It's a balloon. And balloons, when they're stretched too far, don't deflate gently. They burst. By the autumn of 1929, the smart money was quietly slipping toward the exits, even as the public kept pouring in. The whole towering edifice, the whole unwatched, unregulated, self-policing miracle was about to discover exactly what it was worth when the honor system finally met reality. It began to crack in October of 1929. Prices had been sliding for weeks, first a little, then faster, a growing unease rippling through the trading floor. And then came Thursday, October 24th, a day that would be seared into history as Black Thursday. When the opening bell rang, the selling was not a wave, it was an avalanche. Prices didn't drift downward, they fell off a cliff, so fast that the ticker tape, the machine that printed the prices, physically could not keep up and fell hours behind. In the visitors' gallery above the trading floor, tourists who had come to gawk at the temple of American wealth watched in stunned horror. Some of them began to weep. Down on the floor, brokers screamed and clawed and shoved, drenched in sweat, watching the fortunes of a nation vaporize in front of their eyes. And it was in this moment of pure chaos that Richard Whitney, remember him, then the acting president of the New York Stock Exchange, made his most famous gesture. At 1:30 that afternoon, tall and calm and impeccable, he strode across the panicking trading floor to the post where shares of U.S. Steel were traded. The golden pig swung on his watch chain, and in a booming, confident voice, he placed an enormous order to buy, at a price well above the market, announcing to the world that the great banks of Wall Street stood behind their market. It was a show of force, a bid to restore confidence by sheer aristocratic nerve. And for a day or two, it seemed to work. The market steadied. The old boys' club, it appeared, could still save itself. It couldn't. The reprieve was an illusion. The following week, the bottom fell out entirely. On Monday the 28th, the market plunged again, and then came Tuesday, October 29th, Black Tuesday, the single most devastating day in the history of the American stock market. 16 million shares were dumped in a frenzy of pure panic. Whatever confidence Whitney's gesture had bought was gone, incinerated. The market didn't just fall, it collapsed, and it kept collapsing for weeks and months and years afterward. By the time it finally hit bottom, American stocks had lost nearly 90% of their value. 90%. Fortunes that had taken lifetimes to build were gone in an afternoon. The school teacher who had borrowed to buy at the top didn't just lose her investment, she owed money she could never repay. Banks that had gambled their depositors' savings in the market failed by the thousands, and when a bank failed, ordinary people's checking accounts, their entire life savings, simply vanished. There was no federal deposit insurance. There was no safety net. There was nothing. And this is the moment where the story turns, because the Great Crash did something no swindle, no bucket shop, no stock pool had ever quite managed to do. It made the anger personal, and it made it national. The depression that followed threw a quarter of the American workforce out of a job. Families lost their homes and their farms. Men who had been prosperous stood in breadlines. And as the misery deepened, a single, furious question rose from the wreckage and echoed across the country. How was this allowed to happen? Who was supposed to be watching? And the terrible, unavoidable answer was the same one that had been true since 1792. Nobody. Nobody had been watching. The men who ran the market had also been the men who policed it, and when the choice came between protecting the public and protecting themselves, they had chosen themselves. The honor system, the gentleman's code, the whole beautiful idea that Wall Street could regulate its own conscience, lay in ruins as complete as the market itself. The nation wanted answers, and more than that, it wanted someone held to account. And so, in 1932, the United States Senate launched an investigation into the causes of the crash. At first, it went nowhere. The inquiry burned through 3 separate chief counsels, men who were either too timid, too ineffective, or too tangled up with the very interests they were supposed to be investigating. 2 were fired. 1 resigned. The most powerful men in America, the bankers and brokers who had presided over the disaster, seemed untouchable, insulated by their wealth, their lawyers, and their armor of patrician contempt. It looked like the investigation would fizzle out like all the others, and Wall Street would simply wait for the storm to pass, as it always had. And then, in January of 1933, the committee hired its 4th and final chief counsel, and everything changed. His name was Ferdinand Pecora, and on paper, he was the last man on earth you would expect to bring the titans of Wall Street to their knees. He was not a Groton man, he was not a Harvard man, he was not a member of any club that would have had Richard Whitney as a guest. Ferdinand Pecora was a Sicilian immigrant, born in Italy, who had come to America as a child in steerage. His family was poor. As a young man, he had worked his way through law school at night, studying after long days of labor, clawing his way into a profession that regarded men like him as outsiders. He had become a prosecutor in New York, and he had built a reputation, unusual for the era, as an honest one, a man who could not be bought, and who took a particular relish in dismantling the powerful. He was short, pugnacious, sharp-tongued, and utterly, gloriously unimpressed by wealth. The newspapers would soon give him a nickname that captured him perfectly. They called him the Hellhound of Wall Street. And here is where the psychology of this whole saga becomes almost cinematic, because what unfolded in that Senate hearing room over the following months was nothing less than a reckoning. One by one, Pecora summoned the most powerful financiers in America to the witness stand. And one by one, in front of a rapt national audience following every word in the newspapers, he took them apart. He had done his homework, meticulously, obsessively. He knew their books better than they did. And he asked the simple, devastating questions that no one with power had ever dared to ask them before. He went after Charles Mitchell, the head of National City Bank, the predecessor of today's Citibank, a man so relentlessly cheerful in his promotion of dubious stocks that he was nicknamed Sunshine Charlie. Pecora exposed how Mitchell's bank had peddled bad bonds to unsuspecting customers, how the bank's executives had voted themselves enormous bonuses while their customers were ruined, how Mitchell himself had dodged his income taxes through a sham sale of stock to his own wife. By the time Pecora was finished, Sunshine Charlie's reputation was in ashes, and he had resigned in disgrace. The hellhound had toppled one of the most powerful bankers in America, and the nation, reading about it over their morning coffee, was electrified. But the confrontation that mattered most for our story, the one that laid the entire rotten philosophy of self-regulation bare for all to see, was Pecora's clash with Richard Whitney. Remember, Whitney was by now the president of the New York Stock Exchange itself, the White Knight, the aristocrat who had strode across the floor on Black Thursday. And Whitney was defiant. He did not believe the government had any business regulating the exchange. He testified, with breathtaking arrogance, that reformers were making a great mistake, and he declared that the exchange was a perfect institution. A perfect institution. The market had just wiped out 90% of its value and plunged the world into the Great Depression, and the man who ran it sat before Congress and called it perfect. And then Pecora set the trap. He began to probe how, exactly, the New York Stock Exchange enforced its famous listing standards, the rules that were supposed to guarantee that companies traded on the exchange were honest and sound. The exchange had the strictest standards in the world, Whitney boasted. So Pecora asked the obvious question. What did the exchange actually do to check whether the companies were telling the truth in their applications? What steps did it take to verify the numbers? And Whitney, cornered, finally had to admit the truth. Nothing. The exchange took no steps at all. It simply trusted that the companies wouldn't lie. Pecora summarized the whole philosophy in one immortal phrase that should send a chill down the spine of anyone who ever trusted a market. The exchange, he said, proceeded on the assumption that nobody lies to it. There it was, stripped naked in front of the entire country. The self-regulating market, the gentleman's code, the whole grand tradition stretching back to that buttonwood tree in 1792, came down to this: an honor system, a hope, an assumption that nobody would lie. And 1929 had proven, in the most catastrophic way imaginable, exactly what that assumption was worth. The Pecora hearings did what no crash, no scandal, no swindle had ever done. They turned public fury into political will. The newspapers ran the revelations on their front pages for months. Ordinary Americans who had lost everything finally understood the game that had been played at their expense, and they demanded that it be stopped. And in Washington, a newly elected president was listening. Franklin Delano Roosevelt had swept into office in 1933, promising a New Deal, and he understood that restoring the shattered confidence of the American investor was essential to reviving the economy itself. The moment had finally arrived. After a century and a half, the government was going to walk onto Wall Street and become the cop that had never existed. It came in two great pieces of legislation. First, the Securities Act of 1933, which Roosevelt signed on May 27th of that year. Its philosophy was beautifully, deliberately simple. It was built on one word: disclosure. The government would not tell you which stocks were good and which were bad. It would not guarantee your investment or promise you profits. It would do something more fundamental. It would force companies that sold securities to the public to tell the truth about themselves, to register their offerings, to open their books, to disclose the facts so that investors could make informed decisions. The days of selling shares in so many feet of blue sky were, at last, numbered at the federal level. But the Securities Act of 1933 governed the sale of new securities. It did not yet police the great exchanges themselves, the ongoing daily trading where the pools ran and the manipulation thrived. And so came the second, decisive blow. The Securities Exchange Act of 1934, which Roosevelt signed on June 6th of that year. This was the law that finally did the thing that had been unthinkable for 142 years. It created a federal referee. It banned the manipulative practices, the pools, the wash sales, the deceptions that had fleeced the public for generations. It required the exchanges themselves to register with the federal government and submit to federal oversight. And it created a brand new agency armed with real power, the power to subpoena, to investigate, to demand records, to enforce the law. That agency was the Securities and Exchange Commission. The SEC. For the first time in American history, there was a sheriff on Wall Street. And now comes one of the most delicious ironies in the entire history of American government, a twist so perfect that a screenwriter would be embarrassed to invent it. Roosevelt needed someone to run this powerful new commission, someone who understood the dark arts of Wall Street well enough to police them. And the man he chose was Joseph P. Kennedy, the future patriarch of the Kennedy political dynasty, the father of a future president. There was just one small problem. Joseph Kennedy was himself a former stock market operator, a man who had made a large part of his fortune doing precisely the kind of manipulation the new law was designed to outlaw. He had run in the pools. He had played the game. Appointing him to guard Wall Street was, as the outraged press howled, like putting the fox in charge of the henhouse. When Roosevelt's advisors questioned the choice, the president is said to have replied with a grin and a piece of old wisdom: set a thief to catch a thief. And here is the part that upgrades the whole irony from a joke into a lesson. It worked. Kennedy, precisely because he knew every trick in the book, turned out to be a formidable and effective first chairman. He staffed the new commission with serious, talented people. He mediated between the furious reformers who wanted to burn Wall Street to the ground and the terrified financiers who wanted to strangle the new agency in its crib. And in his first speech as chairman, the reformed thief laid down the law with a phrase that still echoes at the SEC today. The commission, he declared, would make war without quarter on anyone who sold securities by fraud or misrepresentation. The henhouse, it turned out, had never been so well guarded. So the sheriff was installed. The law was written. The game was, finally, changed. But history has a way of demanding a final accounting, and the story of the men who built the old lawless world was not quite finished. Because remember Richard Whitney, the White Knight, the president of the exchange who had called it a perfect institution, the man with the golden pig on his watch chain who had strode so confidently across the trading floor. What happened to him is, I think, the single most fitting ending that history could possibly have written. It turned out that the great defender of Wall Street integrity, the aristocrat who insisted the market needed no policing, was himself a thief. In the years after the crash, Whitney had made a series of disastrous private investments, most notably sinking a fortune into a company that made Applejack, a hard cider that some called New Jersey Lightning. When that bet failed, this pillar of the establishment began, quietly and desperately, to steal. He borrowed money frantically, reportedly more than 100 times in a single 4-month stretch, and when the borrowing wasn't enough, he embezzled. He stole from the New York Stock Exchange's own gratuity fund, the money set aside for the widows and families of deceased members. He stole from the New York Yacht Club, where he served as treasurer. He stole $800,000 in bonds from the estate of his own father-in-law. And in the New World, the world with a sheriff in it, he could not get away with it. In 1938, Richard Whitney was exposed, arrested, and charged with embezzlement. He pleaded guilty. When President Roosevelt, who had known Whitney at Groton, heard the news, he reportedly could only say in disbelief, "Not Dick Whitney, I can't believe it." And on a spring day in April of 1938, in one of the most extraordinary scenes in the history of American finance, 6,000 people crowded into Grand Central Terminal in New York City to watch. They came to see Richard Whitney, the former president of the New York Stock Exchange, the very symbol of Wall Street's untouchable aristocracy, escorted in handcuffs by armed guards onto a train. That train carried him up the Hudson River to Sing Sing Prison, where the man who had called the exchange a perfect institution would serve his time. He proved to be a model prisoner. He played first base on the prison baseball team, and when he was released, the titan of Wall Street lived out part of his days managing a dairy farm, supervising 25 cows. The distance a man can fall is measured by how high he stood, and Whitney had stood at the very top of the world. The irony is almost too perfect to bear. The system that Whitney had defended as flawless, the self-policing gentlemen's club, had been so rotten that its own president was a criminal. And it was the new system, the federal cop he had fought so hard to keep off Wall Street, that finally brought a man like him to justice. The old world convicted itself. Now, let's step back and consider what actually changed when America went from a self-regulated market to a federally policed one, because it was far more than a matter of a new agency and a stack of new rules. It was a fundamental shift in the relationship between the citizen and the market itself. Before 1934, the burden fell entirely on you, caveat emptor. If you were cheated, deceived, or ruined, that was the price of playing the game, and the game was rigged by people you would never meet and could never hold accountable. After 1934, for the first time, the government took on a share of that burden. It said, in effect, that the ordinary American had a right to honest information, a right not to be lied to, a right to a market where the referee was not also a player. That is a genuinely radical idea, and it is the foundation of nearly every protection you now take completely for granted. Think about what flows from that single decision. When you open a retirement account today, when you buy a share of an index fund, when you glance at a company's earnings report, you are living inside the world that Ferdinand Pecora and that furious, ruined generation built out of the wreckage of 1929. The SEC that was born in 1934 grew into one of the most powerful regulatory agencies on earth. It polices insider trading. It enforces disclosure. It prosecutes fraud. It oversees markets that now move trillions of dollars in the blink of an eye. It is far from perfect. It has missed enormous frauds. It has been criticized as too soft, too slow, too cozy with the very industry it regulates, an echo, some would say, of the old buttonwood problem that has never entirely gone away. The tension between the watchers and the watched did not vanish in 1934, it just changed shape. And that, in the end, is what makes this story so much bigger than a tale about stocks and bonds, because the question at the heart of it, the question that ran under that buttonwood tree in 1792 and through the bucket shops and the blue sky swindles and the Pecora hearings, is one of the oldest and most difficult questions there is. Who guards the guardians? Who watches the watchers? When enormous power and enormous money are concentrated in the hands of a small group of people, can they ever be trusted to police themselves? For 142 years, America's answer was, essentially, yes. We trusted the club to police the club. We ran the most powerful market on earth on the honor system, and it took the single greatest financial catastrophe in the nation's history, the ruin of millions of ordinary lives, to finally change that answer. It was there under the buttonwood tree, in a private deal to keep outsiders out. It was there in the bucket shops, taking the other side of the working man's bet. It was there in the stock pools, advertising a lie until the lambs were fleeced. It was there on Black Tuesday, when the honor system finally met the truth. And it is here right now, every time a new market, a new technology, a new class of financial wizards insists that they should be allowed to regulate themselves, that they are too sophisticated, too honorable, too essential to be watched. The buttonwood tree never really died. It just keeps growing new branches. The world before 1934 was not some golden age of free market purity, whatever anyone might tell you. It was a world where a widow's savings could vanish into a fake gold mine and the law would simply shrug. A world where the man who ran the stock exchange could call it perfect while embezzling from widows' funds. A world where the referee and the player shook the same hand. But it was also a world of a fundamentally different bargain between the citizen and the market, a bargain in which you were entirely, terrifyingly on your own. Whether the world we built afterward is better, whether the sheriff we installed on Wall Street has truly protected the ordinary American or merely provided the comforting illusion of protection, well, that depends on what you've lived through and what you choose to believe. But understanding that the old world existed, understanding how it worked, and understanding the catastrophe it took to end it, That is essential for anyone who wants to make sense of the financial battles still raging today. Because the question of who polices the market is never really about the market. It's about trust. It's about power. It's about who gets protected, who gets fleeced, and who gets to decide. And those questions are every bit as alive right now as they were on the day 24 men shook hands in the shade of a buttonwood tree and quietly agreed that the only people who could be trusted to watch them were themselves. If this story changed the way you see the market that quietly shapes your entire financial life, do me a favor and subscribe to the channel and drop a like on this video. This is exactly what we do here. We pull back the curtain on the hidden systems, the forgotten histories, and the invisible power structures that run your world in ways almost no one ever stops to question. And if you want to keep pulling on this thread, there's another video coming very soon that you are not going to want to miss. Thanks for watching, and I'll see you in the next one.